Coming up on Market to Market, two Midwestern economists offer their outlook for rural America. President Obama says no to the Keystone XL pipeline, at least for now. Those stories and market analysis with Tom Fitzenmeyer next.
Funding for Market to Market is provided by Pioneer Hybrid, which supports efforts to help families pass their farms into the hands of the next generation. Pioneer, science with service, delivering success.
This is the Friday, January 20 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mark Pearson. Lower gasoline prices offset rising costs for food and medical care and housing last month, offering the latest evidence that the threat of inflation is benign. The Labor Department's Consumer Price Index was unchanged in December. Excluding volatile food and energy costs, so-called core prices rose 0.1%. Prices at the wholesale level, meanwhile, dipped 0.1% last month. Excluding food and energy, core producer prices rose 0.3%. As the cost of pickups, cars, and pharmaceuticals increased. The impact of cheaper energy was readily apparent this week as natural gas prices fell to a 10-year low on weak demand and record supplies. Energy prices, of course, are inherently volatile, and proponents of the Keystone XL pipeline say it would help stabilize oil prices and create tens of thousands of U.S. jobs. The 1,700-mile project would transport oil from Canada, America's largest supplier of crude, across a handful of Midwestern states to refineries in Texas. Critics of Keystone XL, however, adamantly object to the proposed route, which at some points crosses environmentally sensitive land. Stuck between the rock of environmentalists and the hard place of organized labor, President Obama said no to the controversial project this week, at least in its current route. Saying he was under pressure to make a decision on an arbitrary deadline, the president rejected a Canadian oil company's request to build the Keystone XL pipeline through 6 U.S. states. White House officials did suggest the Calgary-based TransCanada Corporation could build the pipeline in sections which would avoid federal government intervention. The oil giant is taking the suggestion under advisement and is looking at building a section from Oklahoma to refineries in Texas. Alberta Premier Alison Redford, leader of the Canadian province that holds the world's third largest reserves of oil, said Canada was disappointed about the decision, but believes the president made it clear an application with a new routing would be considered. President Obama said a February 21st deadline set up by Republican legislators as part of a recently signed tax measure put undue pressure on decision makers. He went on to say the random date prevented a full assessment of the proposed pathway. The plan has raised eyebrows in some regions. In Nebraska, concerned citizens and environmental groups have railed against the pumping of Canadian tar sands oil across the heartland. Hundreds of Cornhusker State residents flooded a town hall meeting in Lincoln last September. Pipeline protesters, including those from the agricultural sector, were strongly represented.
Always remember, whiskey is for drinking and water's for fighting, and we are in a fight for our water. With all due respect to this committee, I would say today the majority of Nebraskans feel like national interest is being defined by the federal government and TransCanada, and that you don't give a damn about Nebraska. What I'm asking is that you move the pipeline away from the sandhills and the aquifer. Despite the slick feel-good commercials from TransCanada, the majority of Nebraskans clearly agree with those who booed the TransCanada commercial at the first 2 Cornhusker football games.
There's a misconception that if the aquifer is contaminated, the entire water supply of Nebraska is going to be endangered, and that's absolutely false.
Much of the concern from agricultural circles and environmental groups involves the massive Ogallala Aquifer, which stretches for hundreds of miles underground in Nebraska and surrounding states. The rich water resource is the lifeblood for rural communities and the region's center pivot irrigation systems. Critics argue a Keystone pipe leak or spill would devastate the aquifer.
President Obama, please vote no for the pipeline and yes for clean water for Nebraska and our neighboring states. Please. Save your children and grandchildren because they will remember your choice. Thank you for your time.
On the other hand, proponents contend it will create thousands of jobs.
Why doesn't the President of the United States that says we ought to create jobs have guts enough to make that decision between the labor unions and the environmentalists? Go with the labor unions, create the jobs, and fulfill your goal and your own political rhetoric, and move on.
TransCanada estimates the pipeline could create as many as 20,000 positions, a figure opponents say is inflated. A State Department report last summer indicated the pipeline would create up to 6,000 jobs during construction. While the administration staves off any decision on the line that would transport nearly 800,000 barrels of oil per day to Gulf Coast refineries, the nation's #1 trading partner is considering a route directly to the Pacific Ocean. The new passage, not without controversy of its own, would open a route to China. Currently, 97% of Canada's energy exports go to the United States. Republican foes are using the denial to gain a political foothold. House Speaker John Boehner accused the president of selling out American jobs for politics and destroying tens of thousands of American jobs while shipping American energy security to the Chinese. TransCanada shares fell more than 5% on the news, but recovered most of those losses later in the session on Wednesday. A monthly survey of economic conditions in 10 Midwest and Great Plains states soared to a 4.5-year high this week. But the barometer also indicated the rural economy is likely to slow in the months ahead. Creighton University's Rural Main Street Index rose 1/10 of a point to 59.8 this month. Now, any reading above 50 indicates economic expansion, and that's its highest tally since June of 2007. When asked what they expected to be the biggest economic challenge for 2012, 26% of the bankers said a decline in agricultural commodity prices poses the largest threat, and 1 in 4 indicated they were most concerned about a shortage of jobs. Increasingly, analysts view those developments as manifestations of larger macroeconomic trends. As mounting financial pressures throughout Europe and Asia weigh on domestic markets, 2 prominent Midwestern economists offered their outlook for rural America.
Agriculture is very healthy, and that's one of the reasons I'm expecting a little bit of the growth to come down for 2012.
Noting robust economic growth in 2011, Creighton University's Ernie Goss and Iowa State University's David Swenson both predicted a potentially stagnant rural economy in 2012. And suggested that agriculture could feel some negative consequences.
You've got growth in the global economy has been expanding fairly briskly. That's particularly in Asia and even in Europe. Now, both of those areas, growth is coming down as well. And finally, you've got a cheap dollar, and the dollar's rebounding. It's grown by about 5.3% over the last 2 months. With the growth in the value of the dollar, that tends to push agricultural commodity prices down.
Swenson examined the renewable energy sector, stating the debates over tax breaks for biofuels are a moot point left now for economic historians to determine. Only weeks after the expiration of ethanol tax credits, ISU's Swenson says demand will continue to drive prices in farm country.
Because demand is maintained, it provides a floor underneath of the prices of both ethanol as well as corn. So that part is going to be sustained. But there's other categories of renewable fuels. We have the wind energy industry. We have our expectations perhaps for advanced renewable fuels. Well, we're not going to make any more corn ethanol. That has maxed out. We may make some more advanced renewable fuels as in cellulosic ethanol, but that is going to take a while to take off. Expiration of the production tax credits for the wind energy is something that has got some people worried that we may see less investment in that down the road.
Goss contends another form of domestic energy could be a boon for rural coffers as long as federal officials develop a consistent policy.
Natural gas is a tremendous potential right now, yet we see our own energy department saying no to exports, or at least they're saying no to exports of natural gas because it might raise the price in the domestic market. Now that is just wrong-headed. We don't have an energy policy. By the way, we need an energy policy. That would be at the state level and more at the federal level, not an energy update. And we have policy of 2 months now. We have for example, the Social Security tax cut is a 2-month extension. Now, I don't know why everyone's not just bowling over laughing about that.
The Social Security tax cut mentioned by Goss was a short-term compromise between the White House and Congress. But the decision over whether to extend the benefits to 160 million U.S. wage earners now is destined for an election year political battle, when federal lawmakers reconvene in the weeks ahead. During his campaign, Republican frontrunner Mitt Romney has championed an aggressive trade stance against China, a chief trading partner with the U.S.
We also go before the WTO and bring an action against them as a currency manipulator, and that allows us to apply selectively tariffs where we believe they are stealing our intellectual property, hacking into our computers, or artificially lowering their prices and killing American jobs. We can't just sit back and let China run all over us. People say, well, you'll start a trade war. There's one going on right now, folks. They're stealing our jobs, and we're going to stand up to China.
But both economists cautioned any political gains won through hard-line trade rhetoric could have dire financial consequences.
You have to believe that the larger economy, the global economy, as well as those folks who really speak for business, they're not going to allow this rhetoric to get out of hand. I think that this is the kind of territory that you negotiate. You don't take absolute and hard stands.
I would be shorting farm income or those companies that are linked to it, because that's absolutely a huge risk. Now, I'm not saying a trade war with China. I'm just saying anything, when you start restricting trade, it doesn't necessarily stop with China. It may move to South Korea. It could move on. And with China would be bad enough. I mean, you get into a trade war with China, it would not be pretty for China or the U.S.
Winter weather advisories were in effect Friday for much of the upper Midwest as a large band of snow and ice pushed its way east. Snow was in some portion of the weekend forecast from Minneapolis all the way to New England, and nearly 700 flights were canceled at Chicago's O'Hare and Midway airports. While large snowstorms are not uncommon this time of the year, the weather in much of the nation so far this winter has been relatively mild. Nothing like last year when Mother Nature unleashed her fury in record proportions. Losses due to a dozen natural disasters exceeded $1 billion in 2011. Federal money has already poured in for many of those affected, and this week even more relief was announced to help repair, rebuild, and guard against future calamities. The Agriculture Department announced this week $300 million in disaster relief funds will be spread across 33 states impacted by tornadoes, floods, and tropical storms. USDA's Natural Resource Conservation Service and Farm Service Agency will administrate the money to help repair farmland and associated properties damaged during the intense year of natural disasters. 20% of the money will go to the state of Utah, where residents dealt with 2 rounds of flooding following record snowpack. Almost $50 million will go to Missouri, which was also inundated with water on the state's eastern and western borders. The U.S. Army Corps of Engineers intentionally blew a hole in a levee on the Mississippi River in an effort to prevent a larger footprint of damage. Water inundated land along the Missouri River for months, and state officials hope to use the money to repair damages and remove silt and debris remaining in drainage ditches and from deadly tornadoes. Tornadoes also ripped through the state of Alabama last spring, causing widespread devastation. The state will receive $16 million overall, with $6 million earmarked for the poultry industry. And tropical storms Irene and Lee left a path of destruction along the eastern seaboard last summer. Now relief is on the way to the tune of $4.2 million in North Carolina, $41 million in New York, and $8.7 million in Vermont.
Next, the Market-to-Market Report.
Grain prices rallied this week, largely thanks to a weakening dollar. For the week, March wheat gained 8 cents, while the March corn contract moved 12 cents higher. Soybeans moved in step with the coarse grains as the March contract gained nearly 30 cents, while nearby bean meal prices advanced $10.40 per ton. In the softs, cotton rallied this week as the March contract rose $3.13 per hundredweight. In the dairy market, nearby Class 3 milk futures were down 92 cents, while the March contract moved 82 cents lower. In livestock, the February cattle contract gained $2.08. Nearby feeders advanced nearly $1.50. The February lean hog contract, however, moved 28 cents lower. In the currency markets, the euro finally ended the week in the black with a gain of 253 basis points against the dollar. Crude oil fell 55 cents per barrel. COMEX gold advanced $33 per ounce, and the Goldman Sachs Commodity Index lost less than half a point to close at 651.80. Well, here now, lend us his insight on these and other trends, one of our regular market analysts, Tom Fitzenmeyer. Tom, welcome back.
Thanks, Mark.
Well, let's start talking about a couple of things that are certainly floating around up there. A little bit of a rebound in the euro. Are we seeing some hope for some solutions in the EU going forward?
Well, you know, they beat that thing up the whole last half of last year. I think we've sort of hit a point where we're going to kind of rest here, see if the things they've done so far are going to do, you know, help any. See, you can pass all these resolutions and make all these agreements and have new governments and all that, but whether implementation and whether the people are going to accept that implementation is really the question. And so we corrected an oversold situation in the case of the euro. We went back up to around 130. Ran into some resistance, and I guess we're going to chop before we start heading back lower as we head into 2012. Now, we have had a lot of bad news out of that. A lot of that's been absorbed by the market, but I still think you're probably going to see recession in Europe next year, and that's going to tend to continue to keep pressure on the euro and strengthen the dollar.
That's right. And, of course, strengthening dollar is a headwind for agriculture. As a rule, what could our export situation be? Obviously, South America, the real could strengthen too, couldn't it?
Right. I don't think that's going to happen, but it could, certainly. We've got some markets that are pretty dependent on you know, I don't think cattle would be where they're at, for example, if we didn't have the exports, or hogs. Directly, it doesn't make that much difference because we don't directly export any corn to Europe, but tangentially, it's gonna make a difference for us.
All right. Well, let's get down to what happened this week and the specifics. And of course, it seems like this USDA report from January 12th is still haunting the market some, and the situation in South America is also haunting the market some. Well, what's your latest on what's happening in South America, Tom? What's your thought on that?
Well, they've gotten some decent rains, particularly in Argentina. I think it's probably stabilized their corn crop. By all accounts, damage has been done. Most analysts seem to think that their crop's going to be somewhere around 18 to 21 million metric ton. That's versus the USDA's last estimate of 26. So there's probably some more down to come there. They are getting rains. They're supposed to get rain this weekend, dry out, and then rain again next weekend. So there are rains coming, and I think that's going to particularly help the bean crop and stabilize the corn crop here.
And that's not going to be much of a catalyst for a bull market at this point.
It's going to be hard to sustain a rally based on that, unless things turn around when we walk back in Monday morning. Then who knows? But
let's talk about let's move over to wheat. Let's talk about that one first, and what you see happening in the wheat market. And we've been feeding an awful lot of wheat, Tom. I know there's a lot of wheat globally, but and the crop is decent so far.
See, that's I think the thing that minimizes this Argentine corn problem is because there is so much wheat, there is so much substitution that can be made. Wheat prices are cheap. Wheat acreages are up. So I think there's going to be plenty of wheat. It's going to be substituted. I think that's going to tend to limit the amount of upside corn has, and probably tend to put a nice floor under the wheat market.
All right, what kind of bracket us in? What do you see for wheat prices for this year?
I think you could see another 20 to 30, maybe 40 cents up in wheat. I don't see anything more than that. If you got those kind of rallies, I'd certainly be a seller.
All right, and that's on this year's crop.
That's on this year's crop, correct.
All right. When you look at the corn market, let's just head right into that. At this stage of the game, there's a lot of bearishness out there. There seems to be a lot of bearish news out there. Informa's numbers were out, 94.8 million acres of corn. We don't know what the weather is going to do. There's predictions that we could see above trendline yields. What's your take right now? If you're a producer, you're looking at some higher input costs, higher seed costs, higher cash rental rates. What do you do?
Well, you've got two markets here. You got this old crop situation where that's relatively tight. 846 million bushel isn't running out of corn, but it's going to make it relatively tight. Farmers are tight holders of that. And I think when you're holding a lot of your old crop, it's pretty tough to go out and make a new crop sale, even though that's probably what needs to be done. If you look back at 2008 when we had the break, everybody looks at it and they go, wow, 2011 crop's this high. I can't sell 2012 at a discounted rate to that. I don't feel comfortable doing that. Well, that discomfort in 2008 cost people a lot of money. It's discounted for a reason, and that's because, like you mentioned, acreage is going to be up. Yield has the potential to be up. Carryout has the potential to be way up. And if that's the case and that happens, we don't really we don't need to have corn at $6. It's probably going to be closer to $4. So there's some downside risk, and with the expenses people are facing for this 2012 crop, it's beyond me why you wouldn't have 20 to 30% of your corn crop locked in at these prices, hoping like crazy that you're wrong and it goes higher on the rest of your crop.
Using a put somehow to
if you're completely uncomfortable making a sale, then yeah, use a put, use some kind of a put call strategy, use something that leaves some upside open. But having just 20%, I mean, there are some of these plants that are offering fairly good basis on new crop corn, hoping to get some corn locked up going into the fall. So take advantage of some of those sort of situations and lock some of that decent basis in way out there before it starts to erode on you.
All right, so you're saying get aggressive on new crop. Decent basis levels right now in some areas. Take advantage of that with moving the old crop.
Again, you get close to $6 plus. We had $6 plus ahead of that January report. If we get back up, 50% of the break that we had would take us March corn back up to around 628. You get up into those sort of levels and you're going to be 6+ cash corn again. I think you got to start moving some corn.
All right. Well, last year is always the big question. Last year we had big prices in July and August, and a lot of people are holding on.
The last 2 years,
right.
That's part of the problem is that everybody says, well, the last 2 years we've had these big run-ups in the summertime. We're
Cash corn was king.
looking at tighter carryouts this year, so I'm not going to sell again this year. And maybe they're going to be right. Maybe it is going to get so tight that but we have a different situation. We don't have the subsidies in ethanol that we had. We don't have the margins for those ethanol producers to pay up for corn like they have the last couple summers. So it's a little different situation, and I'm not sure you're going to see the tightness that jacks that corn price up like it has the last 2 years.
Always with a caveat depending on weather. So
obviously.
Yeah. Okay, all right, let's move over to soybeans quickly. Tom, and what's your take there on the bean market? There seems to be some export news this week. Was that right? Was that China?
There was export news. There's an expectation that China's going to, there are rumors around of as many as 10 to 12 cargoes of beans, which you'd have to figure is them sort of hedging their bets against further deterioration in the South American bean crop. So they're a major force. Next week's their Lunar New Year, so there's not going to be anything happening next week. But the market's really watching that closely and is putting a pretty good buying support, at least temporarily, under the beans. Now, the weather can turn for the better. They can really still have a great soybean crop in South America. So that's kind of the teeter-totter we're on here.
All right. With this kind of a teeter-totter, do you want to do anything in beans right now?
Well, I think if you get old crop beans up toward $12, you have to start to make sales. I think if you get new crop futures up toward $12, $11.80, maybe even, I guess I'd start to make some new crop sales there too.
All right. So
I mean, we're going to be struggling with acreage there. Is acreage beans going to be robbed a little bit and go to corn? Some are thinking both are going to be increased. So I think we're going to have plenty of bean carry out, and if we have good yields, we're going to have a big bean carry out next year.
Let's move on to livestock, which continues to be a bright spot. And even under your scenario where we do get close to $4 corn, some of these calves out there are going to be pretty attractive.
Yeah. The cattle market we had a significant day on Friday where we broke up through February, actually made new highs. We broke up into some significant areas. We've been talking about it for a year now. The numbers are just tight in cattle. They keep getting tighter. Nobody's keep pulling any calves back. And we've been exporting beef like crazy. So is that how sustainable is that? I think if we were just left to the domestic beef market, we wouldn't be able to achieve these kind of prices. But the exports have allowed that to happen. we've gotten the domestic prices up to the point, or right up to that point where every time we've hit it in the past, it's been a problem because retailers can't move the beef, and we're gonna face that again soon over the next month or two and really see if they can do it. The packers have really bid up for cattle in spite of the fact that they're in the red this week, more trying to preserve their market share as much as anything. So we'll have to see if that propels us. You know, the way the charts are setting up, you could see another $5 to $6 put on this cattle market here, chart-wise. So we'll have to see if the fundamentals can support that kind of a chart move.
And with the domestic economy improving, we might be able to chew through it.
We may be able to. That's absolutely. It looks like the U.S. economy is going to at least have a GDP growth of 2%, maybe even a little better than that. People are tending to be more positive, more upbeat about things. So unemployment's going down. Yeah, you're right. We may be able to sell the beef. Again, I think there's upside potential yet in these cattle markets.
Okay. Any strategy particularly you want to use on hedging fat cattle at this point?
Not particularly. I guess if you're really worried and don't believe that, and you think something could happen to blow up the export market or whatever, maybe have some puts underneath. Other than that, I guess I'm not that concerned, particularly in the short run here.
All right, of course.
You had $5 on, and my tune would change on that. But at these levels, I think you need to watch it and see if there's a little more up.
All right. You want to cover any calf buying needs going forward? I mean, this feeder cattle market's been, like you say, there's been no retention, so we're looking at a long period of time here with these same numbers.
Well, they're going to continue to work higher. People are buying the feeder market futures, or they're buying fats to cover the feeder. They're doing whatever they can to try and hedge themselves for higher replacement costs.
And, of course, the hog market soft a little bit on the board this week, but there's some more hogs out there.
It was, but everybody's current. The pork market, again, is going to be a relatively cheap price at the retail level, so I think the pork demand is going to be good. Exports are off a little bit, but just barely. So I think that market's going to be fine too. You move cattle up, and it's bound to pull pork up with it some too. So again, I think there's probably $4 or $5 up in the pork side, and I'd certainly be a hedger if that happened there.
All righty. Tom, as usual, some great insights. Tom Fitzmyer with us this week. That's going to wrap up this edition of Market to Market. Now, if you'd like more information from Tom on where these volatile markets may be headed, why not visit the Market Plus page? It's at our website. You can find expanded market analysis, audio podcasts, streaming video of our program, and links to our Twitter feed and Facebook page, all free at the Market to Market website. And, of course, be sure to join us again next week when we'll assess the market impact of President Obama's State of the Union speech. Till then, thanks for watching. I'm Mark Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Funding for Market to Market is provided by Pioneer Hybrid, which supports efforts to help families pass their farms into the hands of the next generation. Pioneer, science with service, delivering success.